Everyone was waiting for the housing market to crash. People waited through inflation that quietly erased purchasing power month after month. They waited through the fastest interest rate hikes in decades, watching mortgage payments double almost overnight. They waited through layoffs, regional bank failures, and a non-stop flood of headlines warning about bubbles, recessions, and resets. Everyone kept saying the same thing: just wait a little longer. Prices will fall. The system will correct itself. You'll finally get your chance. But the crash never came. There was no flood of homes hitting the market, no wave of foreclosures, no dramatic reset that restored affordability. There was no moment where the math suddenly worked again. Instead, something much quieter happened, something that didn't feel like a collapse, but may end up being far more dangerous. America split in two. On one side, people who own homes. On the other, people who don't. And the longer this goes on, the more permanent that divide becomes, because this isn't just about prices anymore. It's about access. It's about leverage. It's about who gets to participate in the future and who doesn't. Before we go any further, if you want to understand how markets, money, and power actually work behind the headlines, this is exactly why this channel exists. Subscribe now, not because this video will make you feel comfortable, but because it will help you understand the system you're living inside. This story isn't really about housing. It's about wealth formation, exclusion, and why the rules most people were taught no longer apply. For decades, the public was taught to believe housing followed simple rules. If prices rise too fast, they fall. If interest rates go up, demand collapses. If affordability breaks, the market corrects. That logic worked in the past because housing used to be a market centered on people buying homes to live in. That is no longer what housing is. The first mistake almost everyone made was assuming that the current cycle would resemble 2008. In 2008, the system collapsed because it was overloaded with debt, excess supply, and forced sellers. Credit froze. Adjustable rates exploded. People had no equity and no choice. They sold because they had to. Prices fell because the system had no backstop. Today, the structure is completely different. This time, the problem isn't too many homes. It's not reckless lending. It's not even demand. The problem is scarcity. America is millions of homes short, not slightly underbuilt, structurally underbuilt. Decades of restrictive zoning laws, local opposition, labor shortages, rising material costs, and regulatory friction hollowed out supply long before interest rates ever rose. So when rates doubled, homeowners didn't panic. They stayed. Why wouldn't they? Millions of homeowners are locked into mortgages below 3%. These loans aren't just cheap financing. They are assets. They are shields. Selling means giving up a payment that may never exist again and replacing it with something dramatically worse. Selling means trading stability for risk. So instead of panic selling, the market froze. Inventory vanished, listings dried up, and prices refused to fall. This is where the split began, even though most people didn't realize it at the time. Because while supply locked up on one side of the market, demand didn't disappear. It transformed. The people still buying homes today are not the people most Americans imagine. They are not median income families stretching budgets. They are not first-time buyers scraping together down payments. They are investors, institutions, high-income households, private equity, buyers paying cash. Buyers who don't rely on mortgages the way normal households do, and this is the truth that makes people uncomfortable. The housing market no longer needs average buyers to function. If you already own a home, your housing cost is fixed. Inflation works for you. Asset prices rising work for you. Monetary policy inflates your balance sheet whether you take action or not. If you don't own, inflation works against you. Rent rises faster than wages. Savings fall behind asset prices. And every year you wait, the gap widens. This isn't just inequality, it's compounding separation, because housing doesn't just determine where you live. It determines how wealth is created. Home equity becomes leverage. Leverage becomes opportunity. Opportunity compounds into advantage, and over time, ownership stops being a milestone and starts being a gate. The longer prices don't crash, the more power shifts to those already inside the system. Every year, without a reset, strengthens owners and weakens renters. The down payment gets larger. The monthly payment becomes more impossible, and the psychological barrier hardens. People stop planning to buy and start adapting to permanent renting, and this process feeds itself. High interest rates push marginal buyers out, low inventory keeps prices elevated, elevated prices reduce mobility. Then, the moment rates dip even slightly, millions of frustrated buyers rush back in at once. Bidding wars return. Prices surge again. Not because housing suddenly became affordable, but because competition intensified. This is where the narrative breaks. Rate cuts do not fix affordability in a supply-constrained market. They reignite demand. They reward those already positioned. They punish those waiting on the sidelines. That's why forecasts promising a soft landing or gentle normalization miss the deeper issue. Normalization assumes the system wants balance. But the incentives don't favor balance, they favor stability for asset holders. Banks don't want prices to fall. Governments don't want prices to fall. Municipal budgets depend on property taxes. Pension systems depend on asset values. Political stability depends on homeowners feeling secure. A housing crash isn't just economically painful, it's institutionally unacceptable. So instead of allowing prices to reset, the system absorbs the pain elsewhere. It absorbs it through exclusion. Housing quietly transformed from shelter into a financial instrument, into collateral, into yield, and once that shift happens, access becomes secondary, returns become the priority. The market stops asking who needs housing and starts asking who can extract value from it. That's why the crash never came. The system didn't break. It filtered. Those who already owned assets were protected. Those without were pushed further out. And this didn't require a secret meeting or a grand conspiracy. It required incentives, inertia, and time. People were told to wait for kindness from a system that was never designed to be kind. It was designed to preserve value. Waiting became the trap. Because waiting doesn't freeze the market. It allows it to entrench. Each year of waiting locks in higher prices. Each year pushes ownership further into the hands of those already holding it. Each year turns what was once temporary exclusion into something structural. And once housing splits a society, everything else follows. Consumption changes, people delay families, birth rates fall, mobility collapses, labor markets stiffen, politics polarize, trust erodes. A society divided by assets stops functioning like a shared economy and starts behaving like parallel realities. One group builds equity while sleeping, the other pays rent while hoping conditions improve. One group benefits from inflation, the other is crushed by it. And over time, these two groups stop seeing the economy the same way, because they aren't living in the same one. Most people still believe this is temporary, that eventually prices will fall enough to restore balance. But systems don't self-correct when correction threatens the institutions that uphold them. They adapt by narrowing participation. What you're witnessing isn't a housing failure. It's a housing redefinition, and the longer it continues, the harder it becomes to reverse. Because at some point, the divide stops being economic and starts being generational. Children of owners inherit stability, children of renters inherit fragility, and once that happens, the market doesn't just shape outcomes, it locks them in. This isn't the end of the housing story, it's the beginning of a new phase, one where the market doesn't crash. It selects. And that raises the most uncomfortable question of all. If housing no longer exists to house people, then who is the economy actually built for? Because the answer to that question explains far more than real estate. It explains the future.